The modern data center operates as a massive physical engine, requiring highly specialized infrastructure components to function efficiently at scale. Marvell technology started in Santa Clara, California in 1995, building CMOS read channels for the early data storage drive market. Founders Dr. Sehat Sutarja, Pantas Sutarja, and Waley Dai engineered early system-on-a-chip architectures that captured significant market share in hard disk controllers. Over the last several years, the company executed a deliberate multi-year pivot away from those legacy storage controllers and directly into the accelerated computing and infrastructure semiconductor market. This transition redefined their total addressable market and established the architecture for their current valuation. On June 27, 2000, Marvell debuted on the NASDAQ under the ticker MRVL, raising $90 million at $15 a share. Today, the firm holds 875.55 million common shares outstanding, giving it a market capitalization of $171.9 billion. To calculate the true cost to acquire the firm, we have to look at enterprise value, which factors in debt to reach $173.73 billion. That calculation accounts for $2.63 billion in cash equivalents, offset against $4.47 billion in total debt, leaving a net debt reality of $1.83 billion. Carrying $1.83 billion in net debt provides a $171 billion tech firm the exact leverage needed for aggressive research and development without risking liquidity constraints. The operational engine driving that research and development consists of a global workforce of 6,577 employees. As of fiscal year 2024, the demographic split sits at 20.6% female and 79.4% male, with a forward indicator showing 24% of new hires are female. These metrics reflect broader structural realities within the semiconductor sector, where women globally fill only 15% of engineering and physical science roles. This document outlines how Marvell aligns its operations with institutional frameworks, specifically the United Nations Sustainable Development Goals. We see specific tracking targets, measuring gender equality data under SDG 5, enforcing strict labor practices in the supply chain for SDG 8, and a commitment to a 1.5 degrees Celsius climate threshold under SDG 13. For institutional investors, these frameworks serve as measurable risk mitigation and compliance tools to secure long-term stability. We can see the material results of this structural alignment by examining Marvell's SEC income statements from fiscal year 2025 to 2026. This dual-axis chart compares net income and revenue. Starting in fiscal year 2025, the company recorded a net loss of $885 million. In fiscal year 2026, the financials swing upward into positive territory, landing at an audited net income of $2.67 billion. This margin expansion was driven by massive top-line growth, with revenue climbing from $5.76 billion to $8.19 billion over the same period. This growth trajectory continued into the second quarter of fiscal 2026, where the company printed $2.0 billion in net revenue alone. This massive multi-billion-dollar swing confirms that Marvell's new AI infrastructure strategy has materialized into audited, scalable cash flow. Marvell protects this cash flow by avoiding the commoditized general-purpose GPU market, opting instead to build custom silicon tailored specifically for hyperscalers. This includes an expanded 5-year co-design agreement with Amazon Web Services to build custom AI chips like the Trainium 2 accelerator. They also secured a custom AI chip partnership with Microsoft, which is projected to generate between $10 billion and $12 billion in revenue by 2027. NVIDIA has made a strategic $2 billion investment into Marvell to drive the adoption of NVLink Fusion across enterprise architectures. On the inorganic side, Marvell executed a $540 million acquisition of XConn Technologies, structured as 60% cash and 40% stock, to dominate data center connectivity. Simultaneously, they optimized their focus on pure AI infrastructure by selling their automotive Ethernet business to Infineon for $2.5 billion. These targeted acquisitions and co-design partnerships generate deeply integrated enterprise revenue that competitors cannot easily displace. This quadrant matrix maps the global market share battle for AI networking and custom ASICs, plotting general compute versus custom ASICs against mobile and networking sectors. Broadcom serves as the primary U.S. competitor in custom AI networking, while Intel competes in compute, and NVIDIA acts as both a dominant force and strategic partner. Looking globally, MediaTek is pivoting toward premium ASICs, and Infineon occupies the automotive space, leaving Marvell positioned directly in the center of the custom ASIC and networking quadrant. Operating in this specific sector allows Marvell to extract premium margins by dominating the connective tissue between processors, rather than fighting for the processors themselves. Institutional markets have aggressively priced in this strategic dominance leading into May 2026. This chart tracks the intense 52-week price action, climbing from a $58 floor up to an all-time high of $196 in May 2026. The valuation multiples justifying this feature a trailing PE ratio of 28 and a PEG ratio of 1. The company offers a negligible dividend yield of just 0.12%, making it an unlikely target for yield-seeking portfolios. Combining a PEG ratio of 1 with a near-zero dividend firmly categorizes Marvell as a capital-intensive growth compounder. Without a significant yield, Marvell returns capital to shareholders through open market equity mechanics. The board of directors recently approved a massive new $5 billion stock repurchase authorization. They combined this with a $1 billion accelerated share repurchase program, creating $6 billion in total active buyback ammunition. Utilizing cash reserves for heavy buybacks instead of dividends signals clear management confidence in continued stock price appreciation. Marvell has executed a mathematically verified turnaround, shedding its legacy storage origins to become a $171 billion indispensable keystone of global AI infrastructure.